Hi, everybody. Welcome back to another episode of 3 Minute Success. I'm your host, as always, Jarrod Music, here to talk to you about an interesting topic and a little bit of a technical one, hedging concentrated equity positions. So we typically see these show up for our entrepreneur families in one of two ways. The first is that you've sold your company to a publicly listed and traded company where you receive stock as part of the consideration in the deal. The second is that your spouse or significant other receives stock grants, stock awards, an inheritance, something like that, where there's a concentrated equity position that just isn't being terribly well managed. So let me cover the first one first. As you're going through the pre-exit planning process, decide what, if anything, you're willing to do in terms of accepting shares of the acquiring company as compensation. Typically, the more cash you receive, the lower the total value. The more equity you receive, the higher total price the acquirer is going to pay for you. Now, if you receive that equity, there may or may not be restrictions on it. You may be required to hold it for a period of time, let's say 1 to 2 years. Those are pretty common. If you are required to hold that equity for a period of time, you have additional risk that's there. What if the value of the stock goes down significantly before you're able to sell it? This is where you want to either negotiate the parameters of the deal or check it very thoroughly. You can use derivative hedging on a company-specific risk basis. So what happens if you lose a major contract, if there's a litigation action, something like that? You can use stock options to be able to hedge your position. I have a longer blog post that's written about that at entrepreneurline.com where we can get into the details. But essentially, you're purchasing insurance on the stock to make sure that it stays at least below a minimum price range during the time period that you're required to hold it. Now, if you're concerned about industry-specific risk for the basket of companies that your acquiring company fits in, you can look at derivative hedging related to that specific industry. If you're just worried about general market risk because you don't want to be invested in the stock market going forward, you could do market risk hedging where you're, again, purchasing options that go on an inverse basis to whatever the market index is that you're trying to hedge against. Now, you want to make sure that you're not restricted from doing that because often these equity transactions will have restrictions that say you can't use options, and then you're going to have to get a little bit more creative on what you do. Again, my blog post goes a little bit deeper into detail on those. Now, if it's just concentrated equity that's come from your spouse or significant other, let's say they get restricted stock units, stock awards and grants, employee stock purchase program, those should go into your process for creating and maintaining your investment policy statement. How much do you want to hold? When do you want to liquidate? What are the tax considerations for doing so? Just make sure you're clear about what you want to hold and why, and how you want to move on from those shares over time. So hopefully this was helpful as you think about any concentrated equity positions you and your family have accumulated and some methodologies to look at going forward for managing those. Thanks so much for your time.